Okay, dear students, this is Mustafa Mirchawala from Mirchawala's Hub of Accountancy, and today we are going to do the latest SBR pre-mock for September 25 attempt consolidation question. And in the consolidation question, now you'll have consolidation with some standards, and also there is a pre-populated area. The Excel thing is also there. Okay, so as these are the last days, I would recommend you to solve as many mocks as you can. This is basically ACCA SBR pre-mock, but we also conduct our own mock for our own students, and we mark it as well. We give marking facility. So those who are registered students, they should avail it. Now, for your motivation, let me share you the latest results of last attempt. You can see the scores. We have scores in 90s in SBR, 90s in SBR, 93, 90, 80s, 70s. You can see the list. It's a long list. See this second list. Then we have list 3, then list 4, then list 5. Okay, so this list also includes some position holders as well, and luckily in this attempt our students scored 21. Our students scored 21 positions throughout the world. So it's a big achievement and it's a motivation. When these students can do, why can't you? So without wasting any time, let's move towards the ACCA pre-mock consolidation question. So the name of this question is Whitaker Company. W company is a parent of the W group. All group companies prepare financial statements in accordance with IFRS and have a financial year end of 31st December X5. Always this year end is really very important. Year end is really very important. Don't forget this. Okay, now the following exhibits available on the left hand side of the screen provide, yes, number 1, investment in Christon company provides information about the purchase of shares in Christon company during the year. Okay, so it's like during the year means it's like mid-year purchase or like half yearly purchase or something like that. Okay, so let's read this first exhibit and then we'll solve the first requirement, which is very easy. There are very scoring marks in this question. So investment in Christon company on 1st July X5, it's mid of the year, exactly mid of year, because we just read the accounting period. The accounting period is ending on 31st December X5. Accounting period is ending on 31st December X5, right? Okay, W purchased 30% of the equity share capital of Christon at a cost of 1.9 million. Okay, so we have only 30% shares, so looks like it's not control. Yes, but it may be joint control or it is significant influence, something like that. Okay, it looks like, apparently. Let's see. It recorded the shares as a non-current asset. That means this entry is already made. NCA debit 1.9 million or 1900, 1.9 million, and cash or bank credit. This is the already entry made. Normally the entry which we should have made, is investment debit and bank credit. So this is a mistake. So the correct entry should be investment debit 1.9 and bank credit 1.9. So can anybody tell me what is the correcting entry? This entry we should have made, but we made this wrong entry. So the correcting entry will be, let me show you, investment debit 1900. Let's do it 1900, 1.9, because in the pre-populated part it will be 9, and NCA credit 1900. This is the correcting entry, and yes, we need to post this. Correcting entry. Don't forget, we need to post this correcting entry sooner or later in today's class. Okay, so be careful. Now the next thing, an unrelated company, Alistair Company, purchased 55% of the equity share capital in Christon on the same date. Okay, so we bought 30%. There is one more company, there is one more investor who bought 55% shares, 55% shares, okay? The remaining 15% of the equity share capital in Christon is held by several individual shareholders, okay? So the involvement is 55% by Alistair, and we bought 30% and 15% by A, B, C, D, E, F, G, H, okay? So 85, so we and this Alistair makes 85% of the total investment. Now read the deal. Read the deal. This is the deal. Documented discussions. This is the evidence. Documented discussion between Whitaker, we are the Whitaker, and Alistair state that the decisions about Christon's operations and financing structures and investment required 85% majority. That means for every decision, 85% shareholding votes are must. And how this 85 becomes, listen. This is C company. I have 30%. Alistair has 55% and the other guys has 15%. So obviously, these two, 55 plus 30 makes 85. 55 plus 30 makes 85. So these two parties must join hand in order to change anything. So that means they both have joint control. Alistair and us, we are Whitaker. So Whitaker and Alistair both have joint control because 85% majority is must, okay? And if somebody says, sir, 55 plus the other guy is 15, not possible. 30 plus 15, not possible. Only possibility is this. Only possibility, fixed pattern is this. So yes, we have joint control. We, Whitaker, have joint control. This is the proof. Neither Whitaker nor Alistair have rights to the assets. Very good. To the assets held by, nor they are liable to it. Okay. So in joint control, IFRS 11, hope you remember. In IFRS 11, first you need to prove that we have joint control. Yes. Then if it is proved that we have joint control, then there are two types of arrangement: joint operation and joint venture. Can anybody tell me, my respected student, this is joint venture or joint operation? This is joint venture. Why? Because clearly written, we don't have rights in the assets. See this, we don't have rights in the assets and we are not liable for debts. So that means we have rights in the net assets. Both investors have rights in the net assets, and there is one more evidence, that is they have bought the shares. So whenever you buy shares, so normally with shares you get the rights in net assets, not assets. So this is basically joint venture. So this, the way I discuss this thing, 4 marks you will get for this easy discussion. I'll show you easy discussion. Now, neither Whitaker, okay. On 1st July X5, the fair value of Christon's net asset was 6 million at this date. In the year ended, Christon reported profits of 1.4 million. This is the full year profit. Okay, of the joint venture. And they are saying reported gains on debt investment at fair value through OCI. This is the OCI change. For the whole year, OCI change. For the whole year, OCI change is 600,000. See this, okay? Both amounts accrued evenly throughout the year. So one is profit and the other is OCI. Definitely for equity accounting, you need to account for both. Okay? Why am I saying equity accounting? Because once it is proved that this is a joint venture, then my dear students, you need to do equity accounting. And for equity accounting, it's cost of investment, add post profits plus post OCI, all post profits plus post OCI of that associate or joint venture, multiply by your holding percentage. Okay, this is how we'll do it. So giving you like 1 minute, just read it and make your mind. Easy part, very simple standard. You guys have done this standard in the class. We have covered everything of this part like this. Even more difficult question than this. Now, let's see the requirement first. Requirement number one. Using exhibit 1 in accordance with IFRS 11 joint arrangement, explain why Christon should be classified as a joint venture. Okay, so again, you know, after doing this question you need to solve this again and send me. So I'll get you some pointers for this, that how you going to elaborate it. So requirement number A. First of all, you going to write about joint arrangement. Okay, first we need to prove joint control. If you want to apply this standard joint arrangements, so you need to prove joint control. Okay, and joint control comes when two or more entities, I'm just writing the point, two or more entities have joint control. Means they have unanimous, remember this word, they have unanimous rights. Remember, that means if they are not saying yes, no change can happen. Okay, right? This is very important. Means decision about relevant activities needs unanimous consent of parties sharing joint control. Okay, then for this joint control we don't need any formal document, we don't need any agreement or contract. But in this question it is written, there is a discussion. See the words. See, documented discussion between, so that documented discussion is enough. Documented discussion is enough to prove joint control. Okay, now just copy paste the question. In SBR paper this is very common, you need to write things from the question, the 85% thing. Means Whitaker, what is the name of that person, that company? Wait, it is and Alistair has joint control. Now you know there are, once joint control is proved, then the next step is you need to identify its joint operation or joint venture. Joint operation or joint venture. Now tell me, as the parties have no rights in assets directly. They don't have any rights in assets and not responsible for obligations. That's why this investment is a joint venture. Very simple. See, it's simple, simplest. I would say it's simplest, simple flow, simple flow. First of all, you write the name of IFRS 11, joint arrangement, and to apply this standard, first you need to prove there is a joint control. Okay. Then I discuss the definition of joint control. Then I start connecting with the question that documented evidence is enough between these parties. No formal agreement is needed. Okay. Then 85% thing we discuss. Then we discuss joint operation and joint venture, and then we prove that it is a joint venture. This agreement is a joint venture. Now, for joint venture, what is the accounting treatment? Equity accounting. Okay, now 4 marks is done. 4 marks. We have written more than 4 marks. 4 marks is done. But yes, I am doing something extra because in the end, I have to solve the pre-populated part. In the end, I have to solve the pre-populated area, the pre-populated part. Okay. So let me make some entries. Let me make some entries for you guys. Let me make some entries for you guys. Listen. See, this is just, it's my practice in the class. I make such sketches to make you guys understand. So it's going to be 1st of January x5 to 31st December x5. Okay, and your investment date is 1st July x5. Okay, so first of all you need to calculate 6 months profit. Complete year profit is 1400. If you do 6 upon 12, it will be 700 for the last 6 months. This is the profit. Okay, first thing. And complete full year OCI. Full year OCI is 600. Complete full year OCI is 600. OCI gain. OCI gain. So for last 6 months, it's going to be 300. Okay. Now, how are you going to do? You have, listen, you have COI, cost of investment of 1900. Add post profits, post profit share. Post profit is 700. Multiply by 30%, which is 210. Remember, our holding is 30%. 30. Be active. And add OCI share. OCI share. OCI for 6 months is 300. Multiply by 30%. Don't forget this 6 upon 12. Don't forget this 6 upon 12 is very important because we acquired this investment in mid of the year. Okay. So it's going to be 90. So complete amount is 1900 plus 300 is 2100, which is the carrying value of investment in associate. Okay. Sorry, investment in joint venture. In this question, it's not associates, it's joint venture. Now, the most important thing I told you in SBR nowadays, even I have recorded a separate class for double entries, consolidation, double entries. And even I teach routine, I teach double entries because now for consolidation, you must have some grip for double entries. So let's make these. This is already covered. You need to make entries for these two. First of all, listen, 210 and 90. With this 210 and 90, with this 210 and 90, we increase the investment. So we'll debit. Let me make the combined entry. We debit investment in joint venture like 300 debit, and this 210 is means profit is increasing. So profit means retain earning. Profit means retain earning. As this is the SOFP question. So profit means ultimately retain earning. So 210 is retain earning and 90 is OCI means OCE. For balance sheet, for SOFP, it's other component of equity. Okay. So this entry you also need to post. So one entry which I told you in the beginning, that was a slight error in non-current assets. and the other entry is this, and the other entry is this. Okay, so this is for pre-populated part. This entry is for pre-populated part. If you are confident and if you want to win this show, win this paper in the first attempt, be with me, be active during the class. Okay, this is your final preparation. This is your final preparation, please, students. So giving you few minutes, 1 minute to check it out. 1 minute to check it out. Okay, now next question, next. This next one is a good one. It's like, it's about impairment thing with CGU, impairment with CGU. Okay, so investment in Kennedy. This is the second investment. Whitaker acquired control. Now we are parent company and the other company subsidiary. Acquired control of Kennedy in 2000X1, few years back, when it purchased 70%. So our holding is 70% of Kennedy. When it purchased 70% of Kennedy, share capital. Whitaker has identified Kennedy as a cash generating unit. It's okay. Subsidiary is a CGU. At the acquisition date, the fair value of the land, don't forget, owned by Kennedy was 190 in excess of its carrying amount. This is fair value adjustment, FVA. This is upward fair value adjustment. And if you have done consolidation, you know, fair value adjustment is the work of consolidated books. In the individual books, it is not normally recorded already. In the individual books of S company, fair value adjustment is not recorded already. So for the consolidation, you have to record with your hands. Be careful. See, amount in its individual financial. See, as compared to individual financial statement, the fair value is up. The land is still owned by Kennedy at 31st December X5. So we need to adjust in the goodwill calculation. Goodwill on the acquisition of Kennedy was 318. Thank you. See, there are things which are ready-made. The non-controlling interest was measured at its proportion of fair value. See, proportionate method. It's not full goodwill method. It's proportionate method, pre-old one. Okay, don't forget. On 31st December X5, as a result of new legislation, Whitaker conducted an impairment test on Kennedy, finding it to be impaired. Kennedy has been included in the draft consolidated financial statements correctly in accordance with IFRS 3 business combination and IFRS 10 consolidated financial statements, please. However, the impairment has not yet accounted for. So we need to do impairment with these hands. We have to do it. Impairment testing and everything we'll do. The value in use was 3.8 million and the fair value less cost to sell. The value in use was 3.8 million and fair value less cost to sell is 3.85. Now, come on, quick one. Recoverable amount is higher of. Value in use and fair value less cost to sell. Value in use and fair value less cost to sell. Which one is higher? The higher amount is 3.85. Okay. So within seconds, we have calculated recoverable amount. Okay, it's 3.85. Now the very important line, something interesting. The measurement of value in use and fair value less cost of disposal excluded cash flows associated with current assets and total liabilities, all of which generate independent cash flows. See, wait. The measurement, see this, I repeat, I read it. The measurement of value in use and fair value less cost of disposal excluded, not included. Cash flows associated with current assets and total liabilities, all of which generate independent cash flows. So what to do? That means this value in use plus fair value less cost to sell. They have not included current assets plus all liabilities. That means only non-current assets are included. So when in value in use and fair value less cost to sell, non-current assets are only included. So in carrying value, remember, we'll only include non-current asset, nothing else. Because why? We want to do comparison like with like. Okay. So see this. Kennedy's assets and liabilities in its individual, very $1 million line. Individual's financial statement means fair value adjustment not adjusted already. Fair value adjustment not adjusted already. Okay. So they are saying we have property, plant and equipment. Yes, it's non-current asset. Intangible asset, non-current asset. Financial asset, non-current asset. That's it. This is the total. Only include this. Don't include current assets. Don't include any liabilities. Don't include current assets and don't include any liabilities, because we want to do comparison like with like. Oh, I hope you got it. Okay. So this is the question, this is the question, and now we have to eat 10 marks. We need to enjoy 10 marks now. Students, see, everything is on the screen. Everything is on the screen. Okay, read the using exhibit 2 in accordance with IS 36. See, these are the examination marks. Examination marks you are getting, right? Easily clear. See, you are going closer towards your success. In accordance with IS 36, explain with calculation. Yes, explanation also. How the impairment loss in Kennedy is calculated and allocated to the assets of the cash generating unit. Allocated to the assets of cash generating unit. Okay. So first of all, you need requirement number B. Don't forget, it's not full goodwill method, it's proportionate method. Something special I'm going to do. It's proportionate method. If you know the basics, very basics, I'm telling you. So few relevant points you need to highlight. The first thing is comparison like with like. Computation, we will include NCA carrying value to do like with like comparison. That's it. Okay. One thing, and the second thing, how to calculate recoverable amount. Recoverable amount is higher of, we all know, we have done a F7 FR level, higher of VIU and fair value minus CTS. Remember? So I think fair value minus CTS is higher. That's why recoverable amount is 3.85 million. Okay, 3.85 million, right? Now the biggest challenge. Remember, just go to your classes. You have done classes. You have made notes, short notes. I often say in my classes that make your exam folder. Today it will help you. Listen, in proportionate method, goodwill we are holding is 70%. So goodwill is calculated at 70%. Goodwill is calculated at 70%. But all other assets of S company are at 100%. So we need to bring everything to 70%. We need to bring everything to 70%. This is this method I follow in my class. But if you see the past paper, they follow a different method of notional goodwill and all, which is a little difficult for in terms of maths. So it's your wish. You want to follow that method or my method. It's all maths. And you guys have done maths in your life, that for maths different approaches are allowed. Okay, so let me write. So as goodwill is at 70%, so we need to bring all assets carrying value and recoverable amount at 70%. Okay, to do like with like comparison. To do like with like comparison. Right? Let's start now. First of all, I'll write the carrying value of NCA. So what are the carrying values? Let me tell you. Let's pick the total amount. The total amount is 3760. See, this is the total amount. 3760 is the total amount. Okay, I'm not writing separately, it's time wasting. 3760 plus there is a fair value adjustment land which is 190. Okay, fair value adjustment land, because in the it is this 3760 we have picked from individual books, and in individual books fair value adjustment is not already added. Okay, let me write the date as well for your easy. Okay, so 3760 plus 190 is 3950. But now these non-current assets are already at 100%, but goodwill is at 70%. So we'll bring everything at 70% right now. So we'll multiply it by 70%. So this will be 2765. So it is at 70% now. Okay. Now write goodwill. What was the goodwill amount in this question? The goodwill amount was 318, which is already, this goodwill is already proportionate method goodwill. This goodwill is already a proportionate method goodwill, so already at 70%. So you will add these two. You will get carrying value of CGU, which will be 3083. Okay. Now my respected student, listen to me very carefully. See, now everything is at 70%. Now let's pick the recoverable amount. Recoverable amount of CGU was 3850. Remember, 3.85 million. But this 3850 is also at 100%. This 3850 is also at 100%. So make it 70% to make comparison. See, everything. Goodwill is at 70% already. And we multiplied these non-current assets by 70%. So this is 70%, this is 70%, this is at 70%. So obviously recoverable amount should also be at 70%. So this will be 2695. Now let's do the first shot of impairment. Carrying value is higher and the recoverable amount is lower. Carrying value is higher and the recoverable amount is lower. So we have some impairment. Yes, impairment. Listen, how much is the impairment? You take the difference, it's 388. Impairment is 388. Now use your brain, the mathematical brain. When everything at 70%, so this impairment is also for a 70% asset. This impairment is also for a 70% asset. Okay. Now, once you calculate impairment, please don't sleep. Please, just few minutes. Once you calculate the impairment for total CGU, now you spread this impairment to the CGU, and the major step is goodwill. First you remove goodwill. So from this 388, you will cancel this goodwill, and this goodwill will be directly cancelled. This goodwill will be directly cancelled because both are at 70%. No problem. Both impairment is already at 70% and goodwill is already a 70% asset in its own. So it will be directly cancelled. And you know what is the entry for this? You know what is, let me make the entry. In proportionate method, it's not full goodwill method, proportionate method, goodwill is considered to be an assets of P company. Goodwill is considered to be an asset of only P company. So we'll make the entry retain, and it's like P company expense. It's like parent company's expense. So entry will be retain earning debit and goodwill credit. This is the first entry which we need to make and post. This is the first entry which we need to make and post. Okay. But now as a student, you have active eyes. You will say, sir, out of 388 we use 318. Out of 388 we use 318. Yes. So how much is left? Still 70 is left. 70 is left. 70 remaining impairment. Now there is a problem. And those who have taken my normal classes, they know this technique which I am teaching right now. Remaining impairment. Now this remaining, listen, this remaining impairment will be spread over the assets, the remaining assets, over the remaining assets which follow IS 36, Listen, but those assets should be at 100%. Those assets are complete assets. Only in proportionate method, listen, goodwill only is at 70%. In reality, goodwill only is at 70%. All the assets are full, like receivables, cash, everything is at full 100%. So now we need to cancel those assets which are at 100%. So we need to bring this impairment to 100% as well. And this impairment is already at 70%, So how you will convert a 70% thing into 100% by this rule? Listen, this 70 is equal to 70%. So divide by 70, multiply by 100. Your impairment, listen, impairment to be allocated for NCA, this is 100, which you need to bring it to 100%. Why? Because the non-current assets are always recorded at 100% full. But yes, in proportionate method, goodwill only is at 70 or 80%. In this question, it's 70%. Let me say these lines in Urdu Hindi language because there is a big crowd of Urdu Hindi language as well. Listen, just one dialogue, just for their love. Listen. ये जो रिमेनिंग इंपेयरमेंट आई है ना हमारी 70, ये इसी 70% वाली कैलकुलेशन से आई है, तो ये 70% के बराबर है। लेकिन अब ये रिमेनिंग इंपेयरमेंट किन लोगों को उड़ाएगी? अब नॉन करंट एसेट्स को उड़ाएगी, और नॉन करंट एसेट तो सब्सिडरी में पूरे आते हैं ना, पूरे आते हैं 100%, जबकि इंपेयरमेंट तो 70% के बराबर है। तो पहले उन एसेट्स तक जाने के लिए आपको इसको दोबारा 100% वाली हालत में लाना पड़ेगा। तो दोबारा 100% वाली हालत में कैसे लाओगे? 70 डिवाइडेड बाय 70 इंटू 100 करके ये 100 आ गया, राइट? अब ये 100 जाके रिमेनिंग एसेट्स को उड़ाएगा। My dear student, there is one more method for this, which I don't like it, which is notional goodwill method. I don't recommend it. I don't like it. There are students, though they like it, it's their wish. Okay. So now I'm going to allocate the remaining impairment of 100. But remaining impairment of 100 should be allocated to those remaining assets, those who follow IS 36. Those who are in the scope of IS 36, and you know, financial instruments, financial assets are not in the scope of IS 36. So let me move the screen for you quick. See this. See, these are the assets. This PP, intangible asset, and financial asset. Financial assets are not in the scope of IS 36. You know. So you will pick the first two, and yes, in first two there is a fair value adjustment of 190 should be added. There is a fair value adjustment of 190 should be added in PPE. In PPE because it was land. Fair value adjustment was land. Land is included in PPE. Okay. So we will not give any share to financial assets. So this will be, hope you see the numbers. Let me open it to the another screen because I'm going to move the screen. Okay. See, let me write PPE and intangibles. So it was like 2233 PP plus 190 and intangible asset was 957. Okay, so these are the asset. First calculate the total of all these. So total of all these will be 3380. Okay, now let's spread the impairment. This is the impairment column. This is the F7 work which you used to do. F7 in F7 level you used to do. Listen, let's make the fraction. Listen, 2233 plus 190 divided by 3380. See, this is the multiply by what was the remaining impairment? 100. The remaining impairment was 100. Dear student, remaining impairment was 100. So how much is given to? It is 72. 72 should be given to PPE. 72 should be given to PPE, and then the second fraction is 957 divided by 3380 multiply by 100, which is I think 28. Yes. Okay, so this amount will be 2351 and this is 929. The total came out to be 3280. Okay, so see, I have spread this 100 impairment. I have spread this 100 impairment like this. Take your time, take your time, take your time. Please take your time. Now should I make the entry for this 100 impairment? But you know the consolidation rules. In proportion, see, if you compare full goodwill method and proportionate method, the difference is goodwill. Goodwill calculation and NCI calculation. You know, goodwill and NCI calculation are different. But all other assets are same. PPE, receivables, payables, everything is same. All other assets are 100% in both methods. If you know, you know. If you know, you know. If you have studied, you know. The difference between proportionate method and full goodwill method is the goodwill calculation and NCI calculation. All other assets are same in both methods. PPE, intangibles are same. So they are full. They are full. And when a full asset is depreciated, complete asset of S company is depreciated, we distribute the expense between retained earning and NCI. Retained earning and NCI, please. I'm teaching professionals now, strategic people, director level. Treat yourself in boardroom. You are not operational workers now. You are big people. So how to make the entry for this? See, how to make the entry for this 72 and 28, which is 100. Let me make entry here. No. Let me make entry here. So it will be, see, PPE credit 72, intangible assets credit 28. So these two makes 100 amount, 100. So 100 will be distributed into a holding percentage 70-30. So retained earning is 70 and NCI debit is 30. This is the entry. This is the entry for pre-populated. This is the entry for pre-populated, but I'll give you one good news. Just to satisfy the examiner, for this requirement, I have made this detailed entry. But when you see the pre-populated part, they have not given you the breakup of PPE, intangible asset and everything. They have just given you total intangible assets. So in the posting area, we'll write simple NCA. This is NCA. We'll reduce NCA by 100. In the posting area, when I'm going to post in pre-populated sheet, I'll just credit NCA. That's it. I'll just credit NCA. Let me show. I'll show you also. I'll show you. They have not given you the breakup. So this is the good news for you. Easy posting. But yes, just to satisfy the examiner in this requirement, I have done complete requirement with detail. See, the real thing is the learning. The real thing is understanding. You must understand the question. That is the point. Okay. So don't forget to post these. The real thing is posting for the pre-populated area. These two entries are the real for this requirement to be posted. Okay. Right. Now the next and the last area. See, let me show you the requirement. They have written how the impairment loss in Kennedy is calculated and allocated to the assets of the allocated to the assets. How to allocate? That's why I showed the breakup. But in the pre-populated, see, this is the pre-populated area. Definitely we'll go to the Excel sheet. We'll go to the Excel sheet for this. In the pre-populated, see, they have given you total non-current asset. They have given you total non-current asset, no breakup of, so it's easy to post, easy to post. Now the last area of this question, and then we'll happily move to the pre-populated area. Okay, and this case is sub to sub. Remember sub to sub. If you have done consolidation, if you love consolidation, then you must have done this sub to sub, sub S to S. Okay, start. Don't leave the class. Stay motivated. Whitaker acquired control of Freeman on 1st January X2, like years back, like 4 years. See, 4 years back. Today is 31st December X5. Today is 31st December X5, and this date is 1st of January X2. When it purchased 60% of Freeman's equity share capital. At this date, Freeman's recognized net assets in its individual financial statement were measured at 1.58 million, okay, which was equal to the fair value, which was equal. So this is the net assets at the date of acquisition. Be careful. However, net assets means the complete equity packet. Okay. However, Freeman had not recognized a brand name in its individual financial statement which had a fair value of 2. Yes, this is unrecognized brand. Hope you have done the basics, FR level, F7 level. Unrecognized, there are some brands which are not already recognized by S company because of IS 38 rules in the individual books. But now as parent company has purchased subsidiary, this subsidiary. So for parent company, this brand is a purchased asset. For parent company, this brand is a purchased asset. Okay. So parent company will recognize it as an upward fair value adjustment. So this is nothing but upward fair value adjustment. Be careful. Upward fair value adjustment. And yes, there is a 20 years life. So we need to do depreciation as well. Wait. See the takeover date, please. If you understand this part, you will be relaxed. The takeover date is 1st January X2, and you know our year end, the date at which sub to sub will happen, S to S, sub to sub will happen. That date is 31st of December X5. So exactly 4 years gap. Exactly 4 years gap. So I'm going to book a 4-year depreciation on this brand. I'm going to book a 4-year depreciation on this brand. I'm going to do a 4-year depreciation on this brand. Be careful with that thing. Okay. The non-controlling interest at acquisition was recognized at its fair value. Okay, it's full goodwill method. This question is full goodwill method because the NCI is recorded at fair value. So fair value at acquisition date is given. On 31st December X5, when the net assets of Freeman had a carrying amount of 2.42 million, 2.42 million. Okay, read it, in its separate financial statements, Whitaker acquired a further. Now this is the game changing event. Now at this date, now we are talking about 31st the morning, we are talking about the morning of 31st December X5. What happened? We are the parent company Whitaker acquired. See, Whitaker already had 60%. Whitaker already had 60%. So we acquired more 30%. Whitaker acquired further 30% interest in the equity share capital of Freeman for consideration of 1.25 million. Okay. So this is sub to sub. We already had 60%. We acquired 30% more. So previously we had control. Still we have control. So no change in control. No change in control. In economic reality, it's just a change of holding percentage. No change in powers. Now, Whitaker has prepared the draft consolidated financial statement to include Freeman as a 60% owned subsidiary in accordance with relevant IFRS. It has made no accounting entries in relation to the purchase of an additional 30% interest other than to recognize the additional investment at cost. They bought it for 1.25. That means the entry which they already made is investment debit. See this entry they already made. Investment debit 1.25 is 1250 and bank credit 1250. This is the already made entry by them. This entry they already made. I'm giving you 1 minute to read it in 1 minute, and then I'll shift the screen and then I'll give you the plan. This is the case of sub to sub. Okay, now listen. If you remember, if you have taken my classes, on if you are not taking my class, leave it. In sub to sub, right now we are at 60%. We were at 60 and now we bought 30% more shares from 60 to 90. So we pushed NCI back to 10%. So we need to calculate a decrease in NCI. Use your brain. We need to calculate a decrease in NCI. Now how to calculate decrease in NCI? Listen, whenever you got sub to sub, there are two types of sub to sub. If you have taken classes, sub to sub, sometime we need to calculate increase in NCI and sometime we need to calculate decrease in NCI. Okay, so whenever it is increase or decrease, just for the calculation purpose, just one voice which should come from inside, from your heart. Listen, who is seller? Always, who is selling shares? Who is selling shares? This is the best voice you should listen of your heart in sub to sub cases. Who is selling shares? I teach this thing in class always with this topic. Who is selling shares? In this question, seller is NCI. In this question, seller is NCI. Seller is NCI. Seller is NCI, right? Because NCI already had 40% shares. They gave us 30%. Now they are at 10%. So seller is NCI. Seller is NCI. So we need to start working with NCI calculation. We'll be calculating decrease in NCI. We will be calculating decrease in NCI from NCI point of view. Okay. Now I would request you to take the picture of this, so that, because I'm going to move the screen. I'm going to move the screen. Okay. Be careful. I'm gonna move the screen. I'll keep the screen with me on a separate page. Right. Okay. This is the read the requirement also. It's 6 marks. Using C part, using exhibit 3, explain with calculations how Whitaker purchase of additional equity share capital should be reflected in the consolidated financial statement. Okay. Whitaker already had 60% shares, now bought 30% more. So no change in control, no change in control. In economic reality, this is the transaction between equity owners. Okay, so it's just a change in percentage. It's just a change in percentage. Okay. As seller of shares is NCI, so we need to calculate decrease in NCI from NCI working. Okay, so let's start. Listen. Just a sketch. 1st January X2 we acquired, and today is 31st December X5. This is the date when holdings are going to revise. 31st December X5, the holdings are going to revise. So first calculate NCI at this date. Okay, how? The formula for the calculation is, see this, fair value of NCI at acquisition. Remember how to calculate NCI in full goodwill method? You know, fair value of NCI at acquisition is 850, right? Now let's calculate the post profits. Let's calculate the post profit with brain, with a common sense, with brain. Listen. What is the net assets? What is the net assets at this date? Net assets at this date, see the screen. It's 1580. It's 1580. But this net asset does not contain that fair value adjustment. This net asset does not contain the fair value adjustment. So there was a small fair value adjustment of brand of 200. Let me make a little clean. Okay. So, okay. Now what is the net assets at this date? Net assets at this date is 2.42 million. And now can you tell me that brand at this date was 200? In 4 years there should be a 4-year depreciation, because the life of the brand was 20 years. So 200 divided by 20 years, multiply by 4. 200 divided by 20 years, and the 4 years passed. 4 years, so it's going to be 40. it's going to be 40. So 200 minus 40, the brand is 160 here. The brand is 160 here. Can you tell me 2420 plus 160 is 2580, 2580 now, and this was 1780. So how much is the change? How much is the change in the profits? How much in the change in the profit? What are the post profits? Can anybody tell me? What are the post profits? Can anybody tell me of this area? It will be 800. Post profit will be 800. Post profits will be 800. Okay. Now what we'll do? See, don't forget in this whole area. See this, in this whole area, the holding of NCI was 40. Holding was NCI throughout these 4 years was 40%. It changed on the very last day. Okay. So what we will do, post profits of S company 800 multiply by 40%, which is 320. So 850 plus 320 is 1170. Now wait. This is NCI before adjustment at 40%. This is NCI at 40%. NCI at 40%. But now use your brain. Now in 1 second, we are at 31st December X5 morning. And after few minutes, NCI will be converted from 40 to 10%. 40 to 10%. So if somebody is coming from 40 to 10%, there, that means exactly 30% reduction. From 40, original percentage was 40, now we'll come to 10. So there will be a reduction of 30 upon 40. There is a reduction of 30 upon 40, which I would say 75%. If you calculate the percentage, exactly 75% reduction. If you know the maths, See, this 1170 is equivalent to 40%. So now we need to go to 10%. So how we are going to 10%? 1170 divide by 40, multiply by 10. 1170 divide by 40, multiply by 10. This is one method. Or you can directly calculate 1170 into 25%. Okay. And if you want to calculate the reduction, see, reduction of NCI. So reduction of NCI is either 1170 multiplied by 30 upon 40. 30 upon 40, or you call it 75%. There is exactly 75% reduction because we are coming from 40 to 10. 40 to 10, it's 75% reduction. So it's going to be 877.5. It's going to be 877.5. And how much NCI will be left? The NCI left is 117. Wait. 292.5 will be left, although this is not required. This thing is not required. Okay. Yes, but I'll make the entry for you. With this reduction. With this reduction, the real entry we'll make. But we need 1 minute. Okay, now let me make the entry. Listen. See, as this is a reduction in NCI, so we'll debit NCI debit 877.5. Okay, and yes, how much was the carrying real amount we paid? It's 1.1250. Remember in the question, 1.25 million means 1250. So we'll credit our investment because already it is included in the investment. Remember the original entry. We'll credit the investment by 1250, and this will go in OCE, other equity or OCE. The difference will be go in other OCE, which is I think 372.5. Okay, this is the entry which we need to post. Okay, NCI debit OCE. Why this with this difference did not go in the PNL? Because there is no status change, because we already had the control and still we have the control, so there is no status change in. Yes, whenever there is a status change, like you are going from associate to subsidiary or trade investment to subsidiary, then the differences goes in PNL. But here the difference will go in OCE. Okay, here the difference will go in OCE. So this entry is very important, which we need to post. Okay, this is for sure. I have in theoretical point, I've just given you few pointers. You need to write it yourself. Okay, you guys can do it. Don't worry about it. You have done many questions now, many. So the real thing is the all practical part you must understand. This theoretical discussion is whatever you are doing, you need to write. Whatever you are doing, you need to write in simple terms. So now the last requirement, which is pre-populated. But before we are moving, I would request you to take the pictures if you want to take. This is this entry we need to post. The first, this is one entry. Then these two entries we need to post. These two entries, see these two. This is impairment entries. And then we need to post this. Yes, for sure we need to post this, the first joint venture entries. And there is one entry in the beginning. I told you this in the beginning, this entry. Listen, this entry, investment debit, NCA credit, because they have mistakenly included in the NCA. So total one this entry, and then 2, 3 and 4. Yes, for every adjustment there is one entry. For every adjustment there is one entry. For every adjustment there is one entry. Okay, so now let's read the last requirement. What is the last? Using exhibit 1, 2 and 3 and your previous answers. See, they are giving you reference of previous answers. Adjust. Now pre-populated won't take much time because we have done all hard work. Pre-populated spreadsheet. In the spreadsheet response option, to correct the extract from the draft consolidated financial statement at 31st December X5. Okay, right? So I have showed you entries. This is the first, this is one entry, this is entry number 1, this is entry number 2. Take the picture if you want. Entry number 3, these two are entry number 3. I'm saying these all are MP. And then entry number 4, right? These are the 4 entries. Okay, so now we are at the pre-populated area, my dear students. But first thing, be careful. This first column will be ready-made given to you in the exams. These headings, see this heading, this first, second heading, third heading and fourth heading, this you have to give yourself. Okay, right? These headings you need to give yourself. Now let's start the posting. First entry 1900. Remember the 1900, the entry was NCA credit and investment debit. So NCA will be reduced. See, this NCA will be reduced minus 1900, and see, it's plus 1900. Okay, investment in joint venture, I have removed it from non-current assets and I have increased the investment in joint venture. Now, the second entry. The second entry was related to the post profits. Post profits. Remember post profits. So that entry would be investment debit 300, investment debit 300, retained earning. See, this is the retained earning. Retained earning credit, retained earning credit 210, and your OCE credit means increase 90. See this entry we have already also posted. We have also posted this entry as well. Okay. Now the third entry is of impairment. Now let's come to the impairment. For impairment, what we have to do, there was an impairment entry. There was an impairment entry of goodwill. So goodwill impairment entry was, I think, 318. It was 318. Yes. Goodwill credit 318 and retained earning debit. Goodwill credit 318 and retained earning debit. So goodwill credit means reduction in goodwill. See, minus 318. And now let's reduce the retained earning also. So it will be, yes, minus 318. Okay. Right. And there was one more entry of 100, I think. 100, yes. So 100 on NCA will be credited. NCA, non-current asset, will be credited, means reduced by 100. Although I have showed you the breakup, but here the breakup is not needed. Here the breakup is not needed. They have given you total. They have given you, open your eyes, they have given you total non-current assets. Okay. So 100, and this will be distributed between CR and retained earning and NCI. So minus 70 for retained earning and minus 30 for NCI. Sorry, NCI is not here, it's down. Sorry, NCI is here. NCI is here, minus 30. I hope you can see this. I'm sure you can see this. Okay. So almost 1, 2, and 3. Three adjustments, 3 things are posted, but last thing is left. Last thing is left. Okay. And this is in this last thing. This last thing was investment credit, investment in Freeman credit. There is a little error in the original question. Wait. Yes. If you see the original, it is investment in Freeman is written. Investment in Freeman in the original question, it is written in front of Freeman. Okay. What the question which I made already here, I missed the part. Okay. I misplaced it. Like it originally it was written here, but it should be written here. You can see the question of mock. Okay. So now how to make the entry? Remember the entry. The entry was investment in Freeman should be credited now by 1250. So minus 1250. And then we have, listen, debit NCI by it was 877 point. Debit NCI means negative 877.5, and the OCE will be debited. OCE will be debited by 372.5. 372.5. Debit OCE means negative. Debit OCE means negative. See, I have posted the entry. I have posted this last entry as well. Be confident, it's not difficult. Be confident, it's not difficult at all. So all entries are posted. Now finally just total in the last column. Now this topic is not new. This new consolidation is not new for you. You have done many questions in the kit, in the study hub, past papers, many past papers we have solved. Okay, so let's calculate everything here in the total. See this. One 4510. Yes. Now the second is this. I am applying some formula. Okay, some. It's 0. Yes, definitely. Then investment in joint venture. This should be interesting. 2200. Then we have goodwill. Then we have goodwill. Wait. Wait. Okay. So let's apply the sum formula on this. It's 470. Now current assets, I think there are no adjustment. So as it is, the current assets will come here. So let's see the total assets. Let's see the total assets. It's 23560. Total assets are 23560. Now my dear students, come to the share capital. There is no adjustment at all in the share capital. Copy it as it is. Then we have retained earning. Yes, there are a lot of adjustments in retained earning. Okay. Then we have OCE. Then we have, oh sorry, then we have OCE. It's negative 282.5, right? It's negative. Yes, it may come negative. Then we have, if we want to take the total, we may take the total. Let's take it 10870.5. Now NCI will be this number, sum horizontally 1159.5. Yes. Then we have total equity, means this and this, 12030. Perfect. Then there is no adjustment in non-current liabilities. Copy it as it is. Okay, let me move the screen. Then we have current liabilities, again with no adjustment, as it is, copy paste. So let's add the final numbers, total equity, and these three. It's 23560. Yes, it's balanced. It's 23560. The game is balanced. The game is balanced. Okay, so congratulations, question is done. Question is done. Question is done. Okay, I would say it's not an impossible task. It's a scoring task. Even I would say consolidation is a scoring task. There are few topics in consolidation. If you have done good practice, you can do it. Like if it is a 30 marks question, you can score like 22, 23, 21, 25. It's a good healthy score. If you score like 25, 23 out of 30, it's healthy score for SBR. Okay, and I have recorded many lectures on my YouTube channel as well. So if you want to see, you should watch. They are very useful. They help many students. And plus, if you want, if you like this class, if you learned something from this class, give feedback on the comment section, subscribe my channel, and also share with your friends. Okay, so it's time to say goodbye. and I'll record more classes for this mock as well. So stay tuned. Thank you. Thank you. Take care.